And we're back. Welcome to the Kluge Wealth Advisory Group monthly update video for January 2025. In this video, we're going to cover off a few segments, including a market and portfolio update. We're going to touch on our 2025 outlook, as well as we're going to touch on your frequently asked questions that we encountered over the course of our client conversations in this month. So before we get into the content of this video though, I had a couple of housekeeping notes. The first is that on February 6th, we're going to be featuring the second installment of our webinar series on estate planning. And just as a quick reminder, all of our content is available online on our YouTube and X channels. And the second housekeeping item I wanted to touch off on was just a very sincere thanks to every client who shared well wishes and healing thoughts as I went through my battle with a ruptured appendix. Thank you very much. I'm grateful to be here and grateful to be back to my old self. Now, let's get into it. In terms of January markets, the markets were bumpy but good. Early in the month, the S&P 500 started out well, then there were a couple of bumps in the road, and then the market rallied into month end. This rally was broad-based but generally led by value-style stocks in the financial and industrial sectors. In terms of the fixed income markets, yields did initially rise in the month over concerns around tariffs and the implementation of tariffs, but fell after Inauguration Day, especially after weaker than expected US inflation data came out. In terms of commodities, commodity markets rose slightly, but nothing too significant. In terms of January's impact on the portfolio, despite several bouts of volatility, including late month volatility in AI-related names, January was a good month for the portfolio and we finished positive. Importantly, in January, we also completed our annual portfolio rebalance, which we conduct annually to ensure that your portfolio is within its tolerances in terms of its allocation to stocks, bonds, and alternative strategies. Like our rebalance in 2024, this rebalance involved generally reducing equities, especially those that had appreciated highly over the course of the year, and allocating more funds to bonds and alternative strategies. Now, as a part of this rebalance, we also eliminated a name, Lennar Corporation, ticker LEN, that had triggered off my sell discipline, and we replaced it with a position in Block Inc., XYZ, funny ticker, but hey. And Block Inc. is in the business of mobile payments and is growing its business rapidly in several key niches in the United States and internationally. All right, well, let's jump into our 2025 outlook. The bottom line is that for 2025, I'm optimistic on how the year is going to go. And the reason for that is there's a number of very, very important quantitative indicators or pattern recognition indicators, that have signaled that 2025 should be a pretty good year. Now, of course, I want to say that pattern recognition is not a guarantee and that you're only talking about probabilities, but still the probabilities are very strong. So the first and most important trigger that we saw was the first 5 days indicator. Now that indicator says that if the market is up for the first 5 trading days of the year, the chances of a positive year in the market, or in this case the S&P 500, are very high, north of 80%, and typically that return would be somewhere in the mid to high teens. The second piece of pattern recognition or quantitative data that came in that's very positive is the fact that we had a greater than 20% return in 2024. Based on research done by Carson Research, if the market is up more than 20% in the preceding year, there's a greater than 80% chance that the market will return more than 10% the following year. And if you have two 20% years in a row, like we do now, 2023 and 2024, then there's a 100% chance that the market will be up by an average of more than 20%. Now, I do want to warn that that last statistic is based on a limited sample size, so we don't want to get too excited. However, it does bolster the case. And finally, as I sit here filming just before month end, I see that the S&P 500 is likely going to finish the month positive. Now, the January barometer, as it's known, is also a very strong indicator for the rest of the year. There's an old Wall Street saying that says, so goes January, so goes the rest of the year. And we do know that if January is positive, there's a typical pattern that leads to, again, high teens to low 20s return. So, based on the quantitative patterns, I'm positive. Now, if we also look at the portfolio, we are mainly oriented towards the US market. And I think the conditions in the US continue to be extremely friendly, irrespective of any concerns we have as Canadians about Mr. Trump and tariffs. The US is experiencing an increase in productivity, interest rates are coming down, inflation is coming down, and we're seeing that the economy remains strong. And this is just a recipe for good returns, or it has been in the past. Now, I'm often asked about what the biggest risk that I see out there is. And in terms of the portfolio, the biggest risk that I see is actually the potential effectiveness of the Department of Government Efficiency, headed by Elon Musk, but supported by many, many very talented Silicon Valley engineers and other professionals. Now, in general, Wall Street forecasters are not very optimistic that DOGE, Department of Government Efficiency, will be able to cut government spending at all, or even anywhere near the stated goal of $2 trillion. However, I think that this is perhaps not looking at the who's involved with close enough eye to detail. Most of the personalities involved in the DOGE office have a track record of accomplishing what simply has to be said is amazing things in very compressed timelines. And and if you look, they do have and have laid out very, very carefully the case, both legally and procedurally, to carry out their spending cuts. So I think that's an unanticipated risk. And I think that that is a risk for us, because if you see a significant reduction in US government spending, then what is a tailwind to the US economy becomes a headwind. And all else equal, that headwind in this case is big enough to cause a serious growth slowdown or potentially a recession. Now, I of course want to warn that if all else is never equal, and we're going to have to monitor this very closely, but this is the key risk that I'm monitoring. And I think that that's really what could affect us later this year or into 2026. However, the die is not cast, all else is not equal, and this is just going to have to be something that we monitor like we monitor other risks that are in the market. Now, getting into your frequently asked questions for the month of January, I'm sure you're not going to be surprised to learn that most of them revolved around Donald Trump. So we're going to be spending almost all of our time here on that today. Now, before I say anything further, I want to emphasize that as a part of my research process, I've taken a careful look not only at the policies that they've stated, but also the personalities involved. A very keen observer of the news once said that if you know the what, you only know half the story. You also have to know the who, the players involved. So I've also done a deep dive in taking a look at some of the personalities involved and some of their histories to provide some of this observation. And I also want to emphasize, I'm trying to provide observation here. This is certainly not my personal opinion, but I want to be able to separate things so that we can remain objective. And primarily that is because our portfolios are mainly a US-based portfolio at this point. So we're not as impacted by Donald Trump or tariffs as we would be if we were a Canadian portfolio. The second thing we want to keep in mind here in remaining objective is that mainstream media, their business model revolves around using fear in many cases to sell ads by monetizing your attention. So we want to step away from some of the more hysterical headlines or dire headlines and focus on really what's going on. And finally, through all of my observations, I've come to the conclusion that it's very, very, very important to take Donald Trump seriously, but not literally. So with those items in mind, let's get right into it. So in touching on a few questions that we've seen over the course of the last month, I would like to note that there's been a lot of media headlines around potential tariffs between Canada and the US, counter tariffs, threats of energy taxation, etc. And I would like to really note that historically and currently, Canada and the US have had a very integrated economy, and that we've typically resolved our disputes through negotiation. So it seems likely that that historical precedent will continue. And if you're looking for some exterior confirmation of that, you can look to Polymarket. There's a betting contract that allows you to bet on whether Donald Trump will impose tariffs on Canada. And currently, as I'm videoing this, the odds are pretty low. So it would seem likely that diplomacy is going to be the way out of this situation. Now, in looking at why tariffs are a tool that Donald Trump likes, he does continually make references to two presidents, Hamilton and McKinley. And in that era, the United States government relied on tariff income in order to fund itself. There was no income tax, there was no state tax, there was no sales tax. So generally the presidents from Hamilton and McKinley viewed tariffs as tools to reinforce industries that were deemed vital to national security. They used it to raise tax revenue. And I think Donald Trump's twist here as well is he's using it as a negotiating tactic. And I think really that's where Canada fits in. The US administration wants a number of things from us that our current government has been hostile to in the past. And I believe that the US government wants to see an increase in our national defense spending, potentially to be able to defend the North more effectively and free up their resources in other places. They also want critical minerals, lithium and rare earth minerals. They want energy of all types, from electricity to oil and gas, not only sent to them, but also sent to key allies in Europe and Asia. And they want us to spend more on national security in general. Now, this may or may not be the right way to go about this, and we'll let history judge on that, but that seems to be their motivation in terms of what they want from us. And frankly, they're using things like tariff threats and trolls about us being the 51st state as a way to get our attention and to emphasize how serious they are about achieving these ends. Related to questions around tariffs and trade, we did see also a lot of questions around what are the general intentions of the Trump administration. So in touching on this, I'd like to take a moment to emphasize the difference between Trump 1 and Trump 2. Trump 1 did not know how the Washington bureaucracy worked or how the game was played. Trump administration 2, whether it's Donald Trump himself or his advisors, certainly at this point are demonstrating a deep knowledge of how the game in Washington, D.C. is played. And you can see that they're a very focused administration that knows what their priorities are and want to take care of them as quickly as possible. And this is really evident from the large number of executive orders that have been issued, as well as the rapid approval of key cabinet posts. Now, what are the things that they're prioritizing? The first is that they want to see they want to be able to have the United States grow its way out of its current debt, right? They want to see an increase in productivity, and key to that agenda is deregulation, as well as global dominance in artificial intelligence and cryptocurrency. They really see that as an existential need and potentially an existential threat if they are not the leader. And finally, it's important to note that the Department of Government Efficiency, or DOGE, is not just about spending cuts. It's about a fundamental realignment between the relationship of the US federal government and its people. Now, one of Trump's key donors, Mark Andreessen, has been making the rounds on the podcast circuit, has been outlining exactly what they want to accomplish with DOGE, how they want to accomplish it, and the mechanisms they'll use. And there have been several very significant Supreme Court cases in the United States recently that are going to allow them to get a lot of work done potentially. So if you want to check this out, there's a good podcast by the Hoover Institute, but if you were to just simply put Mark Andreessen into your Spotify search engine, you'll find a number of podcasts that he's been on. Some of them are going to be more bro conversations, as you'd find with Joe Rogan. Other ones will be more dry and academic, as you're going to find with the Hoover conversation. So just pick your spot and take a listen. He's very transparent. It's also important to note that in terms of the influence on the administration, there is a huge influence in the administration of the Silicon Valley billionaire set. Now, whether we're talking about Mark Andreessen, who is a founder of Horowitz Andreessen, also the founder of Netscape, or whether we're talking about Mark Zuckerberg, almost universally we're talking about individuals who are ex-Democrats. So we're not dealing with MAGA extremists here. Ultimately, what we are looking at is libertarian, moderate, pro-business type of Democrats who have migrated over to Trump's side because they saw the previous administration under Biden as being hostile to their business interests. So that will definitely exert a moderating influence and will likely, adds a lot of competency and a lot of focus to what the US administration wants to accomplish. Thank you for joining me for the first monthly update video of 2025. As you know, we touched on a portfolio update, a market update, our 2025 outlook, as well as some general comments around questions that we received on Donald Trump and his administration. Now, especially on the latter point, I want to be very upfront in saying, again, none of the things we're talking about are my opinion. They're simply my best observations of what is going on in the current situation. As well, anything that we have said today is, of course, subject to change, and I will change my mind on what we should be doing if the facts change. Now, of course, if you have any questions or there's anything that you want to discuss with the team, please reach out. We're here to help. And as a brief reminder again, we do have that estate planning webinar on February 6th, and that you can find all our videos and all our past webinars and all our content on our YouTube and X channels. Thank you very much, and we'll look forward to speaking with all of you soon.